and 9-month results conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Neeraj Didwania. Thank you, and over to you, sir.
Thank you. Good morning and a very warm welcome to each one of you to Medi Healthcare Services Limited's earnings conference call for quarter and 9 months ended 31st December 2024. The results of the company, the press release, investor presentations have been updated to the exchanges and on our website and also distributed through our mailers. Please note any forward-looking statements are to be relied upon based on your own judgment, and all financials and operating numbers discussed on the call are unaudited and or management estimates. Hence, investors should rely only on the financial documents officially uploaded on the exchanges. Without further ado, I would now like to hand over the call to Dr. Vikram Chatwal, Chairman and Whole-Time Director of Medi Healthcare Services Limited.
Thank you, Neeraj, and a warm welcome to all Medi shareholders and other participants who've joined us on this call. I have with me our CEO, Satish Gidugu, our CFO, Sandeep Daga, and of course, Neeraj Didwania, who also heads up investor relations, just introduced and welcomed you to this earnings call. Today, the financial results for Q3 and the 9 months ending December 24-25 are being discussed and shared with you. But I think as we begin month 2 of 2025, I think it's important to compliment the union government and the union budget with, more importantly, a focus on health insurance and penetration of healthcare in India. While all of us have seen and heard about the increased focus on cancer care, the increased focus and penetration on the hospital or the provider side, I think from an insurer perspective, all of you will appreciate that the FDI limits being raised to 100% is landmark and will clearly open newer doors with greater and deeper integration with global best practices. I think the FDI limit coupled with the simplification of FDI conditions will, honestly, in our mind, provide a stronger foundation for the future of India's health insurance industry. Coupled with that, as all of you would have seen, the Indian government budget proposes to provide healthcare to gig workers as part of the PM Jan Arogya Yojana. This again, I think in many ways is a significant step and will help vulnerable families during their healthcare needs. And so really I think that overall, while the tailwinds continue to be experienced, the Indian economy remains robust, we do continue to see the tailwinds of greater insurance penetration and, more importantly, greater insurance participation with a keen focus on healthcare. As you've seen, us as a business, our focus continues to remain on customer experience. We have continued to focus on medical inflation, and increasingly, you will hear about our continued focus on technology, not only as a tool for automation, but more importantly, increasingly as a tool for fraud, waste, and abuse prevention, machine learning, and AI. While our leadership team on the call today will discuss all of this with you, I wanted to share some of the key highlights for the company for 9 months of FY25. This also can be referred to on slide 5 in the investor presentation. So good news overall. I think that the company continues to head in the right direction. Premium under management was 15,829 crores as on 31st of December. And as you will appreciate, this growth is a growth of 16.6% year on year on a base adjusted for premiums contributed by the acquired companies. This 16.5 odd percent growth, when we share with you between group and retail PUMs or premiums under management, you will appreciate that the group premium grew and was at 13,779 crores, which is a growth of about 15% year on year. And of course, as you've seen quarter on quarter, we continue to demonstrate improvements with a 31% year on year growth on the retail PUM, which is now touching 2,050 crores. All of this also, continues to help grow our share in terms of health insurance premium administered, which is both for group and retail premiums. Over to you. Thank you very much.
Thank you, Dr. Vikram, and a warm welcome to all Medi shareholders and other participants. Thank you for joining this call first thing this morning. And this is also an important occasion for us. We've just completed 1 year of listing. Thank you for all of the support through this year. As Dr. Vikram said, our focus is as an administrator continues to be at the intersection of improving member experience while delivering value to insurance companies, and that's a theme that you will hear as we move forward in terms of our initiatives. We're very pleased to report consistent growth across key operational and financial parameters in the quarter and for the period. We've continued to focus on delivering superior policyholder experience and also strengthening the value that we provide to insurance companies. And our growth across the private and SAHI insurers too is a testament of how our unique capabilities along these two dimensions. For example, Raksha Prime offering minimizing discharge wait times, or our Maven fraud detection engine improving fraud prevention, they are becoming a mainstay as a proposition. We continue to see favorable atmosphere for deploying capital towards strategic initiatives and further our growth and leadership over the long term across the health insurance ecosystem. Moving on to quick business highlights for the 9-month period of FY25. We added 3 new private insurance companies in our retail book. In most of the cases, this is likely to be 100% of the book that we will administer. We grew premiums administered in the group segment for private and SAHI insurance by over 40% year on year. As that segment moves its focus towards group segment, we are well positioned to participate with them and grow alongside with them. Including all of our acquisitions on the combined base, we've improved our retention of group accounts to 95%. And during the year, we also created hubs of excellence for our claims processing, given the extremely large volume of claims that we processed. We processed over 6 million claims in the 9 months of FY25. These hubs have begun to deliver operational efficiency and also allowed us to absorb the requirements from the Master Circular compliance on the claims processing side. We've run events to enhance awareness and visibility and also to establish thought leadership in the industry. We hosted our Industry First Conference and Awards, Raksha Summit 24, focused on the theme of borderless health benefits. We released a Borderless Health Framework report in partnership with Boston Consulting Group, BCG, highlighting industry trends across multiple aspects of life and also in realizing the Government of India's vision for all by 2047. Medi Insurance TPA Private Limited, a wholly owned subsidiary, signed agreement in August 24 to acquire 100% equity shareholding of Paramount TPA. And we are awaiting the regulatory approvals, and then the transaction will be concluded subsequent to receiving the approvals and standard closing conditions. On all of this, like Dr. Vikram said, we continue to focus on technology as the mainstay for delivery. We have built a technology platform for the international private medical insurance business for our Mayfair line of business, and the platform is now live, and over 35% of the policies that Mayfair historically served are already live on the new platform. And the platform allows very interesting capabilities like a cashless network discovery across the globe, and also very seamlessly handles multi-currency cross-border payments in the international insurance space. Our Raksha Prime program enabled over 65,000 patients till December to walk out of the hospitals without waiting for discharge formalities. And this is powered by our proprietary AI technology for predicting out-of-pocket expenses. In fact, in the month of December, we crossed 10,000 discharges a month milestone, and it's improving month on month. Our continued improvement in AI-powered Maven fraud detection engine capabilities, increased detection of fraud cases with much higher hit rates from our process, but a 2.5 times growth year on year in the value of savings delivered to insurance companies through fraud prevention. I'd now like to hand over the call to Sandeep Daga, our CFO, to give you a quick set of financial numbers.
And a warm welcome to all the shareholders of Medi and participants. Thank you for joining the call. The financial highlights for the 9 months are the total income for the period was INR 550 crore, which was equivalent to a growth of 14.2% over the corresponding period of the previous year. Revenue from the contracts with customers, excluding other income, we call it as operating revenue, was 534.4 crore, growth of 14.3% again over the same period last year. The revenue from the contracts includes 10.3% from the government business and 4.9% from the international benefits business. The EBITDA, excluding other income, was INR 113.4 crore for 9 months, which was equivalent to a growth of 17.7% year on year and translates to a margin of 21.3% on the operating revenue. The PAT during the 9-month period was INR 69.9 crore, a growth of 53.6% YOY over the same period last year, and translating to a margin of 12.7% on the total income. Key balance sheet line item and the operating metrics as on 31st of December, the net cash balance in the books was INR 266.5 crore. Net worth as on date, this 31st December was INR 531.6 crore, which is equivalent to a return on net worth of 13.2% for 9 months and 17.6% annualized. Return on capital employed was 14% for 9 months and 18.7% annualized. One of the key metrics for us happens to be the revenue per average headcount, excluding the government contracts, was INR 10.6 lakhs for 9 months and INR 14.2 lakhs annualized. I now hand over the call back to Neeraj. Thank you.
Thanks, Dr. Vikram, Satish, and Sandeep. We can now open the call for questions from the participants.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Madhukar Ladha with Nuvama Wealth Management. Please go ahead.
Hi, good morning, everyone. So first, we've seen a good growth in premium under management for this quarter. But if I look at the domestic non-government revenue, that's only grown about 1% QOQ. So can you help me understand why the growth has not come? And, you've also not given the contract liability number for the quarter ended. So that will also be helpful. Second is on the fundraise of 350 crores. So what are our plans? Why do we need the money? What are we thinking? That will be another question from me. And third, we've created a large deferred tax asset. What is this? And I'm guessing this is sort of one time. So yes, these will be my 3 questions. Thank you.
Thanks, Madhukar. I will attempt to answer the growth question, and then I will hand over to Neeraj and Sandeep for the other questions. So we've seen actually a good growth in premiums, and as you understand, as you are aware, we recognize the revenue over a period, so there's a bit of a lag in the way the non-government revenues actually show up. The contract liability is about 227 crores as of December, and that continues healthy from an overall revenue perspective. There's still the softness in the growth in employment numbers. Having said that, if you've looked at some of the announcements that we spoke about, we've added 3 new insurers in retail in this period, and of course the business will start flowing in as we move forward and the renewals take place. And on government, with the amount of work the central and the state governments are doing and the expansion of the schemes and how they've become extremely performance-oriented and rewarding benefits administrators who are able to deliver to the performance KPIs. We are also seeing an increase in our ability to participate in government schemes profitably. So, and hence you also see a bit of growth on the government side. We are in line with the industry growth rates on group, and I think it's just a timing of these, for us to see the revenue from the growth. Neeraj, you want to answer the questions?
Yeah, so like Satish gave you the contract liability number already, it's 227. And on the revenue side, Madhukar, also if you see last year, so Q2 to Q3 generally is sort of a flattish quarter for us seasonally also. So that's why I think there has been a decent growth in premiums, and you see some of that come into the following quarters. But on the revenue front, even without the government, year-on-year basis, it will be like a 12.7, 12.8, so nearing a 13% year-on-year growth. So it's quite healthy that way. On the DTA, it's largely because of Raksha, and I'll bring in Sandeep to clarify on that.
Thank you, Madhukar. On the deferred tax asset, there was a reversal on account of the Raksha merger, the approval of which we got during December. As a result of which, there was a one-time reversal on the deferred tax liability which we had created when we acquired Raksha. So this is a one-time benefit which we got during the quarter, the impact of which happens to be roughly around 8 odd crores for the quarter as such. The ETR for the same reason stands at roughly around 14%. We, however, believe that for the full year, it will bounce back to 18 to 19 odd percentage by March 2025.
And Madhukar, just on your question regarding the fundraise, from time to time, the company keeps evaluating its capital structure and sort of capital allocation strategy. Satish did mention in his opening remarks that we see a very favorable environment for future growth opportunities. So this is an enabling resolution. Of course, there are some deployments and some capital allocation the company has already made announcements towards. But at this point, after the LODR, we're not able to comment on timing and exact usage, but it will be updating. We'll be keeping on updating the investors based on what approvals from shareholders and from board we get.
Understood. Just a follow-up on the revenue growth number, and the derived yield then for the quarter seems to have taken a pretty sharp hit. So if I just look at the yield adjusted for the contract liability number, that comes to about 2.42%. Versus, we were at about 3.1% sort of, in the previous quarter. So what am I missing over here, and how should one look at this?
Madhukar, I think maybe if it's okay, we'll take this question offline and answer, because the contract liability is a combination of all the revenue lines that we have. And while the premium is only for the group and the retail business, I think that it's best that I'll ask Neeraj to work offline to address this question. But just to answer your original question, we're not seeing any sharp decline or even a significant change in the yield from where we are. In fact, we're able to hold yields fairly well.
Okay, understood. That's helpful. Thanks.
Thank you. The next question comes from the line of Mohit Surana from HDFC AMC. Please go ahead.
Yeah, hi, good morning. Two questions from my side. If you can just, the fundraise that we have sort of taken an approval seems a significant one. So if you could probably share some thoughts around that. And secondly, a technical question. I see a reduction in cash balance. So if you could just give some thoughts around that. Thanks.
Thanks, Mohit. Yes. Thanks, Mohit. Was your first question regarding the fundraise?
Yes, correct.
Yeah, so as I clarified to Madhukar, from time to time, we need to relook at our capital structure and also at the cash deployment opportunities and capital allocation strategies. So we do see a favorable environment to further growth in the future. And of course, we have a deployment coming up in terms of Paramount acquisition, which is an announced public disclosure. So right now, we've taken this as an enabling resolution. We cannot comment anything further. But as we get the approval from the board and shareholders, we will keep everybody updated. But we're not allowed to talk anything regarding the timing or the use of funds at this point of time. So this is more an enabling resolution to plan for the next few years of growth. And of course, there are some deployments already announced in public disclosure. So that is one. And for the cash balance question, I'll pass it to Sandeep.
Thanks, Mohit. Primarily, the cash balance between September quarter and December quarter shows a decline, but it is primarily attributable to the distribution of the dividends which took place during October 2024.
Understood. Thanks a lot. Thank you.
Thank you. The next question comes from the line of Prakash Kapadia from Spark PMS. Please go ahead.
Yeah, a couple of questions from my end. What is the employee count as on date versus last quarter? That's the first data keeping point. Secondly, in group health, we've seen across the industry, claims ratio being much higher, and we've also seen 1/N norms affecting growth. So any, growth going forward outlook changes at our end, given what is happening in the industry and some of these regulatory changes?
Thanks. This is Satish here. I'll take your question. So from a 1/n perspective, we are not impacted because we've always taken our revenue only for the year and in fact for the period, right? We actually defer our revenues at each policy level over the entire servicing period. So we are actually not impacted by that reporting change at all at our side. And our headcount ending December 31st is 6250. While and almost all of any net increase in the headcount compared to March is only on account of the new contracts in the government business, which are typically headcount-driven contracts. Otherwise, in our core business of our group and retail and other technology and other lines of business, the headcounts have been relatively flat over the 9-month period.
Okay. And Satish, essentially what you're saying, even this 1/n or the group claims ratio, which we are seeing a spike across the board, doesn't have any impact on potential quarters or coming quarters also, is what you're alluding to?
Yeah, 1/n is not something that impacts the way we recognize our
I'm saying from the insurance company's perspective, because, their growth seems to get affected, these norms and the claims ratio which they are facing. So I was trying to assess the impact because of these factors at their end. So if, the customer is facing higher claims ratios or the customer is facing some of these regulatory changes, could that affect our growth going forward is what I was trying to assess.
Understood. 1/n is only an accounting change, so we don't expect that impact flowing into the customers in any way. But from a loss ratio perspective, our average inflation in our medical inflation that we deliver in our portfolio has always been sub 5%. Even for the 9 months period, it is sub 5% in terms of increase in average claim size. Our network continues to deliver significant savings, over 700 crores of savings delivered to insurance companies through pushing into our cashless network. In fact, many of the insurance companies that we work with now are using our network for their portfolio. Lastly, as we said at the beginning of this call, we've significantly invested into capabilities for preventing fraud, waste, and abuse, which is actually a fairly large outgo for the insurers. And we've improved the amount that we're saving to insurers by almost 2.5x compared to month on month. I think that's where we've very clearly stated between Dr. Vikram and I that our focus is on delivering superior experience for members while absolutely relentlessly focusing on improving outcomes for the insurers. So we hope to be the right partner in that journey.
Yeah. No, just to add to what Satish just said to you, Prakash.
Yeah, no.
I think it's a fair question that you've asked, saying what does happen given the fact that there is an impact of what we typically call a vintage drag.
Right.
So incidence sees a little bit of a spike as the vintage of a portfolio continues to grow, and the insurance industry, the insurer, in our mind, is potentially looking at a little bit of that vintage drag. But Prakash, a good way to think about life is, as time goes by, and given the tailwinds, given the GDP growth that the economy is seeing, given new employment that is being created, I talked about the gig economy and their coverage. We talked about the government increasing its coverage, and hopefully, overall, as you can also see from the taxman's perspective, we're putting back more cash in the hands of every citizen. I think over a period of time, if you look at it as just a period event, yes, the vintage drag does impact it, but over time, I think, Prakash, our view is that this will normalize, right? It's par for the course. We're seeing a little bit of this spike happen now. Right. But, as more and more lives come on board, and you are seeing that consistently the growth numbers are there. Yes, they have been a bit subdued, but one hopes and expects that this will kind of catch up. And once it does catch up and you see new lives being added, it
The one-time expenses basically contributed to roughly around 1.5% dilution in the quarterly margin. In case if you were to remove that, it will have an impact of roughly around 20 bits for the 9-month period and approximately 1.3-1.4% for the quarter.
Sure, thanks.
Okay. Thanks, Pradyuman, for that question. So Pradyuman, just to to step back, I think it's been a question that's been asked to us over and over again. And as you hear on this call, there are 3 new insurers that have actually come on board to work with us on the retail portfolio. Jahan ki, where in the past it was always us saying, the insurers typically will keep the retail portfolio in-house. So I think, I think directionally, Pradyuman, first of all, I don't think there is a shift in the power dynamics whatsoever, right? This is all about customer experience. This is all about fraud, waste, and abuse control. This is all about technology. And lastly, all about the quality of the network pricing and the medical inflation that our CEO just spoke about. So, in our mind, Pradyuman, the view is that increasingly the industry is getting sharper in its focus on what it needs to do to control medical inflation, what it needs to do to improve automation, and what it needs to do to be able to increase its focus on and deliver greater savings through fraud control. Now, all of this finally also, if you see what has happened with the regulator, and which I think is directionally a very good step, is to improve the policyholder experience. When you look at experience and you overlay technology, fraud, waste and abuse, medical inflation, you will see that at least in our mind, insurers are becoming sharper in their ability to identify what will deliver best value to their policyholder. And so we, over the last year since we listed, we have always talked about the fact that directionally we see the penetration of TPAs in partnership with insurers solving for the health insurance penetration issue over time. So really, honestly, in our mind, अगर आप आज बैठ के देखें, we consistently believe that this is a partnership with insurance companies, and that there is a much sharper and a keener focus on improving policyholder experience. And clearly, at least from a TPA perspective, our view is that TPAs are doing an equally, if not a better job, at being able to deliver on the policyholder promise. So we don't actually see this, as being a conflicted view कि ये अंदर रहेगा या बाहर जाएगा. This is more about policyholder experience, and I think insurers have, come to terms with the idea that the TPAs are doing a good job at solving these problems. Clearly, from a Medi Assist perspective, I can speak that one of the reasons why more and more insurers are participating and partnering with us to deliver policyholder experience is because of the investments that we have continued to demonstrate that actually improve policyholder experience.
No, sure, that's very helpful. Just a follow-up question, if I may. So in the RHP, we had seen that TPA penetration is around 55%. So if you could give me
the current number if possible?
I don't have that specific with me, but Neeraj, if you can share that if there is any penetration number that you have.
Yeah, hi Pradyuman. So we don't get the entire data from all the TPAs, and from time to time we've seen sort of irregularity in how they report. But broadly, our estimate is even on the most recent numbers from the TPAs is roughly about 70% to 75% of group premiums of the country are managed by TPAs. This number would be lower to about 35% in the retail, 30 to 35%, and broadly it should be around still a 50-50. And these things are, so they're not a straight line trend. We've seen, if you see the RHP that you're referring to, we put a 5-year trend where there were periods where the penetration went down to 48%, went up to 58%, was then at 51 to 55 range. So what happens is year on year, because this is a 12-month cycle, there could be policies that go in-house, there could be policies that come back to TPA portfolios. So broadly, I think directly you should take it as more and more insurers are empanelling us on the retail side. On the group side, we are growing faster than the industry and within the private side portfolio as well. And like Satish and Dr. Vikram spoke about complexity and policyholder experience, we feel that compared to the in-house, we put a very strong proposition. So that way TPAs are becoming more and more critical to the ecosystem.
I also think, Pradyuman, I think the key message here is, while the TPA industry as a whole is difficult and hard to comment on, given the paucity of data available at this point in time. Look, I think please understand that from a Medi Assist perspective, your company continues to increase its footprint on the group and on the retail side, as demonstrated even in the last quarter. You've seen that 3 new insurers have come on board. And this is all driven by what I just said to you a little while ago. So clearly from a Medi Assist perspective, we see a trend that continues to demonstrate the strength of the partnership between us and the insurer industry.
Sure. That's very helpful. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question comes from the line of Ajox Frederick from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, my question is on that one-time expense. So on an adjusted basis, our margins can reach a steady state level of 23% type from where we are right now, because this is the first time our margins are inching beyond or closer to 23% in a few quarters. So that is the first question.
Sandeep, would you like to take that, please?
Yeah, if we adjust for the one-time expense, and considering that in the last 1 year and all, we have gotten the benefits of the integration of the past acquisitions, we are heading in the right direction, and on a quarterly basis, we are somewhere closer to 22% as such, once we discount the one-time acquisition which we saw.
So that 1.4%, what is the absolute quantum of spend that was made, if you may give that number? That one-time spend.
One-time quantum of spend will be in the range of roughly around 1.822 CR during the quarter, which is resulting into around 1.2% for the quarter and approximately 30 odd bits for the 9 months.
Got it, sir. That's helpful. So secondly, on the 3 new insurers you have acquired, how sizable can this be in your sense? If you can give some color on that.
Thanks for that. We don't currently publish insurance-specific numbers, but I think the way to look at it is today we work with 28 insurance companies in the group portfolio. So that is almost all that are actively participating in group. The retail insurers, if you refer back to the RHP, we were around 11, 12 insurers that we used to work with, and now gone up to 16 plus insurers. In majority of the new business contracts on retail, we are nearly 100% at a product level or a portfolio level. Of course, as the portfolio sort of starts moving at one policy at a time, you will see the accretion. But on retail market share, we are over 6% from an overall industry perspective, and that's a number that has steadily grown.
Okay, so very helpful. Congrats on all this.
Thank you. The next question comes from the line of Prateek Jain from Solidarity Investment Managers. Please go ahead.
Hello, am I audible?
Yes, sir. Please go ahead.
Yeah, hi. Hi, sir. Thanks for the opportunity. So my first question is, like government business, where we earn revenue has a number of lives covered. Why isn't that the case in the group business where we are earning as a percentage of premium? That's my first question. And my second question is, when we approve any claim, how does the process of cash payment happen? Do we send the required ask the required amount to the insurance company to pay to the hospital, or is there some sort of payment done from our end? That's my two questions, sir.
Thank you, Prateek. Maybe I'll start with the second, easier. We do not handle any payouts as per the regulation. So our job sort of ends once we adjudicate and make a recommendation and collect all the documents, bank details, requirements, and then hand over to the insurer. The payments always leave directly from the insurer's bank account and then directly reach the beneficiary's bank account. That's the regulation. So we have no working capital or payment exposure that we deal with today. And from a revenue perspective, for most of our core business, which is non-government, which is group and retail, is a percentage of premium, based model. Almost all of it. In very few instances, there is any other model. Right? We earn in the same model both in group and retail.
Yeah, I get that, sir. But my question is more that is there any risk where the regulation changes and you are asked to pay, get the revenue has a number of lives covered instead of % of premium?
And the commercial arrangement between the insurance companies and the TPAs is a subject matter of the two parties entering into contracts, and regulation does not have a view on the commercial arrangements between insurers and the TPAs. The first thing. And second, the regulation today, if you refer back to the Master Circular, very clearly lays out the roles and responsibilities of insurers and TPAs and provides recourse for both sides on how the service delivery needs to happen. But even in there, the commercial arrangements between insurers and TPAs are clearly left between the two entities.
Just to add to that, Prateek, आपने जो सवाल पूछा वो सही है, लेकिन we don't expect and we have not seen any change in the fee model that is prevalent today in the industry. The fee model is very straightforward. We get paid as a yield on the premium for group and retail policies, and for the government, we get paid as a fee per life, per family per year. और उसमें कोई बदलाव आने की कोई मतलब ऐसा we don't see anything that is going to really change in that model today. This is a model that has worked in the Indian context over the last 25 years, and we don't expect any change there.
Thank you. Mr. Prateek, may we request that you return to the question queue for any follow-up questions, as there are several participants waiting for their turn. The next question comes from the line of Uday Pai from Investec. Please go ahead.
Hello. Thank you for the opportunity. I had one question. We have been hearing that there is downward pressure in group pricing on account of intense competition due to EM regulations. So, are you saying that firstly? And secondly, do you expect that some part of the downward pricing would be transferred to us as yield deflation? Thank you. That's it from my side.
Thanks, Uday. Satish here. So I think with the more and more of the private and the family insurers also beginning to look at group as a growth driver, clearly there is competition, in the market from an insurer's perspective. In fact, interestingly, it in my opinion, it works in our favor because of the competition and the tight underwriting. It becomes even more important to make sure that the customer experience is superior so that the retention can actually improve for the insurers. And second, there is a much tighter delivery in ensuring that the loss ratios are in control, especially through better control on medical inflation and fraud-based and abuse. In fact, we are beginning to see the tightness in the premiums in the competition playing in our favor because it sort of plays into our strengths of managing customer experience and the insurers' loss ratios and adequately.
Sure, sir. Thank you.
The next question comes from the line of Akshay J. from Exponent Tribe. Please go ahead.
Thank you for the opportunity. I had a couple of questions. One is that on the Paramount acquisition, can you kind of give us some sense of the A, timeline by which we expect the transaction to complete, and B, maybe pro forma, how is that business doing? Second, sir, on the claims inflation point that you had spoken about in the early part of the call, that we deliver a significantly lower claims inflation relative to the market. If we hear the retail-focused insurance companies, everyone has been complaining about how their claims are sort of not in control. Why do you think, despite them having worse claims experiences in-house, do they continue to prefer doing that versus working with someone like us who as we claim, have significantly better claims experience? So that's my two questions. Thank you.
Yeah, hi Akshay. So first on the Paramount timelines and performance. So Paramount acquisition was signed in end of August. Our experience in the last two acquisitions, which was Medvantage and Raksha, is it's anywhere between a 4.5 to goes up to a 6-month approval cycle, and then could be a 30 to 45 day period of actual closing actions, which includes conditions precedent and some closing actions. So at this point of time, we will stick to what we said when we signed the transaction, that we believe it will be within the current quarter, but it's difficult to say because we are already in Feb and we are awaiting the IRDA approval. So if it spills over, it's difficult to say at this point of time, but we'll keep everybody updated. Of course, once the IRDA approval comes, we'll make that public disclosure. On the performance, Doctor, do you want to add anything on the timeline?
No, not at all. Akshay, like Neeraj rightly pointed out, there is nothing outside of what we think is routine. So, as and when in the next weeks things develop, we shall keep you updated on where things are.
And second, on the performance, it's of course, we had put out their numbers. They were about 153 crores of top line in FY24 and a single-digit adjusted EBITDA margin, which is really the norm in the TPA industry, apart from us, where we operate at 21. So they are among the faster-growing TPAs, is all but now their numbers are public at this point. They will continue to have some amount of growth on the FY24 numbers. That's all we can say at this point in time.
So like Neeraj alluded to in the previous question, about 70-75% scale and the reach and the focus on digital actually help TPAs get there. Retail historically being a simple indemnity product with a low incidence rate and very focused on inpatient only. But as the retail is growing in complexity from a product design perspective, bringing in flexibility at par with the group products, or especially with for example, Akshay, we processed by count more outpatient claims than inpatient claims. And it's a massive shift in the way the products are sort of evolving. So as the incidence rates change, and also like Dr. Vikram said earlier, as the retail portfolios of vintage keeps increasing because the fresh inflow is not showing up in the retail book, there is pressure obviously in retail in terms of loss ratios. Clearly, I think our focus has been in blending customer experience delivery with focusing on what's important for the insurers, which is fraud-based and abuse prevention and managing medical inflation, which is the reason why we believe that we've grown from a 4 many years ago the insurers that we served on retail to a 16 plus today out of the 28 that are out there. It's a journey, but we think that by continuing to focus on these two aspects and we'll continue to improve our right to win as Medi Assist. I cannot comment on the overall TPA industry.
Yes, sure. I agree with Satish Akshay that the medical inflation, vintage drag, and partnership with TPAs, or at least with Medi Assist specifically, in our view, is a secular trend.
Fair, sir.
Thank you. The next question comes from the line of Niharika Karnani from CapGrow Capital. Please go ahead.
Hello.
Yes, ma'am. Please go ahead.
Yeah. So my question is, private insurers and SAHIs, those who have in-house TPA system, is there any conflict of interest, and is that pushing them to get TPAs on board?
Niharika, none whatsoever in our mind. One, and the reason I say none whatsoever is because, as you can see, we are working with 3 private insurers additionally and adding up to a total of 16 of them, up from where we began our journey many moons ago. And I do not believe that I just gave a short while ago, talking about experience coupled with medical inflation, in abuse, and automation or technology. We see this as a secular trend of greater participation and partnership between all insurers, all classes of insurers, and TPAs, and there is no conflict of interest that we are aware of.
Understood. Thank you.
Thank you. Questions from the participants. I now have the conference over to the management for closing comments.
Thank you everybody for your active participation, and we are available offline to address any further queries regarding our business and financials. We look forward to your further interaction and staying connected. Please write to us at investor.relations@mediassist.in to be added to our mailing list. Thank you.
Thank you, everybody. Have a great day.
Thank you. On behalf of Medi Healthcare Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.